Now, Canada has a population of 41 million people. There are 31.2 million credit cards in circulation. When you remove children, elderly, and those with mental disabilities, regardless of income level, debt level, or intelligence level, there is more than one credit card per person. Now, as per Fairstone, the average monthly credit card spend is $2,300. Now, let's pause for a second. Am I the only one who fell off his chair when he saw this stat? Now, let's rationalize this $2,300 that the average Canadian puts on their credit card. Your largest expense is your rent or your mortgage. That does not go on your credit card. Your second largest expense is your car payment. That does not go on your credit card. Then after that, you have your monthly car insurance or your home insurance. That does not go on your credit card. Then you come down to your utilities, gas, electricity, water. That does not go on your credit card. Then you have your property taxes or your condo fees. That does not go on your credit card. So guys, let's dig a little deeper. The average Canadian earns $72,000. Okay, after taxes, it's roughly $54,000, which means the average Canadian takes home about $4,500. Now let's look at a very common scenario. Let's assume you rent. Your portion of the monthly rent is $1,800. Your car payment is $500. Your car insurance every month is $125. Okay, so $4,500 minus $1,800 minus $500 minus $125 leaves you with $2,075 in your bank account. And by the way, you still haven't put $1 in your savings. You're left with $2,075 in your bank account, yet you're putting $2,300 on your credit card. That means at the end of the month, you're left with a deficit of $225. Guys, let's get real. Your groceries, your phone, your internet, your household items, a little bit of miscellaneous cannot cost $2,300 a month. You are clearly purchasing a bunch of UC. Now, in the event you missed previous episodes, UC stands for useless crap. I need you to subscribe right now so that you get the blocks required to achieve financial freedom. While you're at it, like the video so I feel your love and I continue to teach you what your teachers failed to teach you. And listen, leave your questions in the comment section and I'll be more than happy to answer you back. Fairstone then goes on to report that the credit card balance for Canadians is $4,265. It means it will take a paradigm shift in your spending habits to climb out of this debt. The average interest rate on a credit card is 23%. $4,265 at 23% is $980.65. The balance will continue to grow. And this concept is called compounding. And compounding means you pay interest on top of the interest. If all this isn't scaring you, here's another fact. North Americans have succumbed to the idea that debt is a part of life. Excessive debt has been normalized in your head. It is your way of coping and justifying your current situation. Guys, listen, I love you. I've seen this happen many times. This movie does not end well. At some point, banks and credit card companies will pull the plug and stop lending you money. Before that happens, please get out of this black hole. Let's quickly get into good debt, okay? A good debt is when you purchase assets through a loan, but these assets are appreciating assets. Now, an example of an appreciating asset would be to buy a primary home. Now, the benefits of owning your own home to live in is number one, you build equity. So a portion of your mortgage payments, a portion is interest, and the other portion goes towards paying off the principal of the debt, which means you're building equity. On top of that, the value of your property is increasing, which is also increasing your equity. Number two, it will help improve your credit score. As you make monthly payments, your credit score will improve. Banks will be more open to lending you money in the event that you want to purchase more appreciating assets. Number three, you are no longer renting. The money that you pay towards your rent is a sunk cost. And a sunk cost means a money that you have spent, but it will provide no future benefit to you. The fourth reason is that when you retire and you downsize your home, it will leave you with excess cash to help fund your retirement. Another type of a good loan is to purchase an investment property. So your primary residence is where you live. An investment property is a property that you purchase to rent out. The reason why it's a good debt is, once again, you will build equity. The second reason is that you will have access to capital. When you start accumulating assets that are appreciating, banks are then open to lending you more money because you now have collateral. Collateral is something that you can say, hey, Mr. Bank or Mrs. Bank, in the event that I can't pay off a debt, you now have this asset to help protect yourself. The third reason is you are also building a retirement nest by accumulating these assets. Number three, taking a loan to invest in stocks and bonds. Yes, this is actually a real thing, and a lot of institutions do practice this. Now, people say there might be a risk. What if the markets collapse? What if something happens? Hear me out. Over the past 40 years, the average return, whether it's the NASDAQ, TSX, S&P 500, the average return has been roughly 10%. During this inflationary period in North America, we were at the 7 to 8%. We never hit 10% or 9%, which means even then, over the long term, the long spread, you will cover that loss. Now, the benefit of this is that you don't have to, if you don't have money to invest in stocks and bonds, these institutions will lend them to you. Then this money that you have borrowed will not even show up on your credit score, because the money stays with the institution who lent it to you. It's still in their possession. Number two, this will help you generate passive income. Number three, you will have extra income, which can now help accumulate other assets to help generate more passive income and to help fund your retirement. The last type of good debt that I want to talk about is taking a loan to start a business. When you start a business, you generate revenue. You incur expenses because you're running a business. But in theory, your revenue should exceed your expenses, which leaves you with a profit, which then allows you to maintain your lifestyle. However, before you get into any business, it is very important to think through things. Do not make an emotional purchase. Have a proper business plan. Have professionals surround you and guide you in the right direction. Now, the benefits of owning a business is, number one, you now become your own boss. The amount of effort you put into your business should, in theory, correlate into more success. Number two, the profits that you generate through your business allows you to qualify for additional loans, which then allows you to accumulate more appreciating assets. Number three, it helps you preserve your capital. There are many tax strategies for business owners, which helps them pass on the wealth that they accumulate to the next generation. Guys, listen up. You can do it. Step one, go into beast mode, have that paradigm shift that I can do it. Have that belief. Number two, stop purchasing UC items and services. Okay? If you have to live like a hermit for the next little while to pay off your debts, you do it. And that's that beast mode mentality I'm talking about. Okay? And then what that means is you will eventually become the boss of your own destiny. You will pay off your debts. You will then be able to access loans, which you can then invest in appreciating assets. Listen, do not work for your money. Have your money work for you. And remember, it all starts with a simple conversation.